When it comes to making sound financial decisions and investments, it is important to have a plan in place. Goal-based investment planning is a key element in any successful investment portfolio. It is essential to take the time to assess your financial goals and identify the best strategies to reach them. This video will provide an overview of goal-based investment planning and outline key steps to create an effective plan. Goal-based investment planning is an individualized approach which takes into account a variety of factors. These include current financial circumstances, future objectives, and risk tolerance. By carefully considering all of these elements, you can develop an effective plan for achieving your desired financial goals. This video tutorial will provide an overview of the various steps involved in goal-based investment planning, from evaluating current financial resources to identifying investment opportunities. We will also discuss the importance of diversifying your portfolio, setting realistic goals, and how to monitor your investments over time. By following the steps outlined. 1. Understand your financial goals. The first step in goal-based investment planning is to understand your financial goals. What are you trying to accomplish? Are you saving for retirement, a house, a wedding, or a vacation? Do you want to invest in stocks, bonds, mutual funds, or a combination? Knowing what you want to achieve and when you want to achieve it is essential for creating an effective goal-based investment plan. Additionally, you should consider any financial obligations you may have in the future, such as student loan payments, car loans, or other debts. Having a clear understanding of what you want to achieve and what you are willing to sacrifice for it will help you make the most of your investment opportunities. If you need help in setting up your financial plan to achieve your financial goals, please book a free discovery call by visiting bookme.planetwealth.in. 2. Define the time frame for each goal. Once you have identified your goals, the next step is to define the time frame for each one. This is important in order to determine how much money you should save and invest in order to reach your desired outcomes. Depending on your individual financial situation, you may choose to break down each goal into smaller, achievable objectives, or you may set longer-term goals that span several years or even decades. Setting a timeline for each goal will help you to plan for the future and stay motivated to reach each one. It is also good to create milestones or check-ins along the way to stay on track and make adjustments if necessary. 3. Calculate the amount of money needed for each goal. The third step in goal-based investment planning is to calculate the amount of money needed for each goal. To do this, you need to consider the cost of the goal, the inflation rate, and the expected rate of return of the investments that you plan on using to finance it. The expected rate of return may include both capital gains and income earned on investments, such as dividends and interest. Once you have all of these figures, you can estimate how much money you will need to save to meet your goal. 4. Evaluate your risk appetite. Evaluating your risk appetite is an important step in goal-based investment planning. Risk appetite is the amount of risk you are willing to take in order to achieve your investment goals. It is important to note that risk and return are linked, and so if you want higher returns, you need to be willing to take on more risk. Before committing to any investments, it is important to assess your risk appetite to ensure that you are comfortable with the level of risk associated with the investment. It is advisable to be conservative in your estimation of your risk appetite and to err on the side of caution. 5. Consider the tax implications. One of the most important considerations when it comes to goal-based investment planning is understanding the tax implications. Depending on the type of investment you choose, the amount of taxes that must be paid can vary drastically. For example, stocks, mutual funds, and ETFs are usually taxed at the capital gains rate, while interest from fixed income investments such as bonds and CDs is typically taxed at your marginal tax rate. It's also important to understand that distributions from retirement accounts, like NPS, are typically taxed at your marginal rate. Understanding the tax implications of your investments can help you make the most of your investments and reach your goals. 6. Select the appropriate investment products. Knowing which investment products to choose can often be one of the most difficult steps in goal-based investment planning. Depending on your individual goals, you may want to invest in stocks, bonds, ETFs, mutual funds, or other securities. It's important to take the time to research the different types of investments available and to compare their risks, returns, and fees. Once you've selected the appropriate investment products for your goals, you should make sure to regularly monitor and adjust your investments as needed. 7. Monitor your progress regularly. The seventh step in goal-based investment planning is to monitor your progress regularly. Tracking your investments is important to ensure that you are on track to meet your goals. You should review your investments regularly to ensure that they are still in line with your goals, risk tolerance and time frame. Make sure to watch the market performance of your investments, analyze your portfolio performance and watch the fees you're paying. This can help you make adjustments as necessary to ensure that your investments are still aligned to your goals. 8. Rebalance your portfolio as needed. Rebalancing your portfolio as needed is an important part of goal-based investment planning. This is because markets are constantly changing, and your portfolio needs to be adjusted to ensure that it continues to meet your goals. Rebalancing involves selling off some of your investments that have become too large a portion of your portfolio and buying more of those that have become too small. This helps maintain a balanced portfolio and reduces the risk that your investments won't be sufficient to reach your goals. Additionally, rebalancing will also help you to stay disciplined and focused on your investments and goals. In conclusion, goal-based investing is an important part of achieving your financial objectives. By setting clear and measurable goals, you can develop an investment plan that is tailored to your individual needs. With careful planning and the right investments, you can reach your goals and build financial security. If you wish to create your personalized financial plan to achieve your financial goals, please book a free discovery call by visiting bookme.planetwealth.in.